Right. Okay, great. So my question is, well, it's not a question more, it's an observation which I'll ask you to comment on. I've been investing, for years and years and years. And in the past, whenever I felt twitchy about being in the market, there's always been an alternative. And, my favorite alternative was index-linked bonds. In the good old days, you could put your money into, a government bond yielding 4% or a real return of 4%. There is no alternative. There is nowhere else you can put your money. And it seems to me that if interest rates were to rise, perhaps as a result of the inflation caused by the devaluation of sterling, if interest rates were to rise, then there could be a really big catastrophe.
In terms of a market correction?
Yeah.
I mean, Mike, you're probably not an expert. I know you obviously have your reservation without wishing to stuff you into a UK question when you're an Asian expert.
Well, thanks for that.
No, I can take it on the chest if you wish.
No, it's fine. No, I share the sentiment very much. Correlations in all asset classes are really high, and that to me is I didn't talk about that, but that is another indicator to make you nervous. As you say, there's nowhere to go, and as a result, everything's going up at once. Which as soon as you get a change in circumstances, and you've highlighted one there. I mean, we've had quite a lot of attempts at circumstances which could maybe change that norm, with the political twos and fro's we've had through this year. It hasn't happened yet. I've no idea if it happens in 2017 or not, but it is certainly a reason to be nervous. I mean, I would say going forward, uncorrelated asset classes, of which there are still a few, are more attractive, in my opinion. So if you can find uncorrelated asset classes, then that alleviates some of that. Even if not necessarily you're getting the yield for it, but at least you're taking yourself away from the high correlation argument.
Does that help at all?
Yeah, what uncorrelated assets are we talking about?
I was trying to be vague. Because if you can find... I mean, things like frontier markets.
Historically, you could look at things like hedge funds, you could look at private equity, you could look at VCTs. Again, I'm not saying they're without risk, quite the opposite. But if you look historically at private equity funds and hedge funds, they actually tend to outperform at different stages of the cycle and actually can inversely correlate. So again, that's one way of going about it. One of the examples I always use here, I intentionally didn't talk about it because I've flogged it to death in my presentations this year, is Dylan Grice's cockroach portfolio, where he tried to come up with a portfolio designed to weather any economic scenario, not necessarily market scenario, but inflation, deflation, stagflation, just because the cockroach, let's face it, they're kind of indestructible. So he wanted to come up with something that did the same, and it was a 4-bucket portfolio, a bit like Andrew's, but different buckets. It was 25% physical gold, 25% equity income, 25% high-quality bonds, if such things still exist, and 25% cash. Now, at any one time, one of those is going to make you feel terribly uncomfortable, and one of those is going to make you feel terribly smug, and the other two probably somewhere in the middle. But over the last 30 years, and I've kind of quasi-back-tested it, it's actually only had 2 down years, and it's shown a lot less vol than, say, the S&P 500 or even bonds. So I'm not saying it's perfect, and to be honest with you, I think most people looking at those buckets now would say, oh, I feel pretty relaxed about equities, which probably means they'd be the one that would go wrong first. And the bit that would make me most nervous is bonds, funny enough, given, all right, some of that has happened a lot in the last 3 or 6 months, but in your scenario, you would be a bit nervous about fixed income still, for example. Gold, oddly enough, has been a dog in the second half of this year when you'd have perhaps expected it to have done better. But again, that tends to do best when there's fear that central banks have lost the plot or are behind the curve. So we'll see what Janet Yellen said 44 minutes ago for a guide on that, perhaps, when we get out of here. Next question, please. Gentleman down here, please. Oh, Emmy, sorry, you've been pulled thither. Andreas is being lazy down at the back. Thank you very much.
This is a very simple question about exchange-traded funds. If I invest in an index tracker fund, a normal historical index tracker fund, I would expect now a dividend income of plus or minus 3%, depending on where you are. With an ETF, what happens to the income? What happens to the dividend income, which someone must be collecting, presumably somewhere?
Oh, yeah. ETFs, just like a tracker fund, can come in an accumulating asset type of share class. So the dividends are accumulated and added into the net asset value of the ETF, or others are distributing as well. So you would then receive dividend payments. So it really is exactly the same. We offer, British investors tend to prefer distributing. German investors prefer accumulating for one reason or another. So many of our LSE-listed ETFs happen to be distributing. So you would actually be receiving those income payments, those dividend payments. So yeah, that's just like a tracker or a regular mutual fund.
Gentleman down here, please. Thank you very much. And hopefully we'll get some further down the back. Thank you, Emma.
Thank you. I must say my sort of safety fund is actually still short duration credit funds. I noticed that spreads have obviously come in. Well, they have come in, we know. I'd be, first of all, interested in your views on what might cause them to blow out again. But actually my main question was to do with emerging markets. I really think there's opportunities there. But I wanted to talk about CEMEA and LATAM. With oil prices coming up and with possibly a rapprochement between Russia and America, do we have opportunities in CEMEA? And where does NAFTA take us with LATAM?
I'll take short duration.
You take short duration.
You want to take short? I mean, yeah, it is the textbook place to look. If you do think that interest rates are going to rise, it does give you that degree of capital protection. It's by no means perfect. Clearly, what you're gaining in capital protection, you're potentially sacrificing in terms of yield. The other option is, if you wanted to be a little bit more aggressive, is go for a flexible or strategic bond fund, where they can obviously play across the full range of geographies, asset classes, and maturity. So that would be a further option. But yeah, if you do think that interest rates are going to go higher, then generally, if you're looking at fixed income, short duration will hopefully give you some degree of capital protection while still bringing in some degree of reliable income. Yes, that's the
spreads on the credit spreads.
Yeah, I mean, what could cause credit? I mean, in the end, I think if you particularly if you've got junk, high yield in corporate debt, then spreads have come in. I think mainly because the oil price has rallied. So much US junk debt has been issued by oil drillers and shale drillers and hole diggers over the past 3 to 4 years. If OPEC's been speaking with forked tongue, perish the thought, then and the oil price starts to go back down again, then that I think would potentially put a lot of pressure on high yield spreads really, really quickly. Other than that, the market is currently complacent, relaxed, dare one say, because I think it feels that default rates are incredibly low and going to stay very, very low because central banks have got everybody's back. I mean, there are things that do make you nervous. I mean, there are many things in the US that are currently growing quicker than corporate bankruptcies, which does make me worry. You've got 6 million Americans who are 90 days or more behind their loan auto payment, their auto loan payments. So there are some worrying signs bubbling underneath, which are all debt related. It's not hard to construct a scenario whereby and global indebtedness is 30% higher than it was in 2007. So it's not hard to construct a scenario whereby the debt markets start getting quite ugly quite quickly and spreads blow out. In the end, economic disappointment. If the Trump magic wand doesn't work, and I do share a lot of your reservations about that, that would also potentially put some pressure on. Normally, you start to see default rates, fully enough, rise when the economy is improving, because that's when banks see a chance to get out, and that's when the firms need more working capital. So that can be a pressure point as well. But I think oil would be my big one if I really had to pick something.
Can I just jump in? I'm sorry, but
Come on,
there are now
the
interest rate hedged ETFs available. We just launched one 3 months ago. So you're basically you're stripping out the interest rate risk and simply being left with the credit aspect of that. But
Asia.
Well, it's a LATAM question
LATAM,
more, which is not.
And CEMEA.
Okay.
Of course, it's not really my area of speciality. I'm much more Asia, but I can give you some views, although probably not that well-educated views. But I think EM now, as an asset class, is 70% Asia. So what you're talking about, the other 30%, very commodity-focused, very energy-related. So investing in EM as opposed to Asia, what you're doing is adding a bit of commodity and energy risk on top of an Asian-based portfolio. And again, I'm going to take the fifth on this as well, because I have no idea where oil prices are going at any point. I do think there's a structural element to demand on oil. People are using less oil over time. I think that's a given. However, the supply side is what's driving the price, and I really haven't. That's politics, and I'm going to step right back from politics because I really have no idea. I mean, you've heard it's quite a lot of it's a kind of summary. We really have no idea, do we? but you know, at least we're being
It's
honest.
good to know
I
it's
suppose. I know.
good to know your limitations. I
It
tell
is.
you.
So that wasn't really an answer. Because I don't really know the details, but you have to make a call, I think, on energy and commodity prices to be confident in investing in the EM space in general.
If I may just follow up on that, I was also thinking about the political rapprochement that may go on between America and Russia and open up opportunities.
Again, that's not really my speciality. I can give you my view on the US and China, which is probably just as pertinent.
Or Taiwan,
as this,
for that matter.
or
which
Taiwan,
is
which is the same thing, to be honest. And I don't know. It's politics, but if the Trump administration does anything like what it said in the lead up to the election, then I think we're in for a whole world of worry. I'd like to think that that's not going to happen. If Trump sits down with corporate America and corporate America tells him how important it is to sell goods into China, you know, Apple sells more phones in China than it does in the US. Do you really want trade embargoes here? Do you also really want trade embargoes with a country that owns 15% of your treasury market? You know, so, you know, this is all saber rattling and posturing. And the Taiwan thing as well is very unfortunate. But I'd like to think that that plays out smoothly, because that's the only way it has to play out. Otherwise, as I say, I think we're on for a whole world of hurt.
Yeah, I mean, there are very few things that economists can agree on, but one of them is that Smoot-Hawley in 1930, which introduced tariffs in the US, was one of the things that made the 1930s the disaster that they were, economically speaking. So yeah, it's to be hoped that somebody can point out a little bit of my favourite subject history to the president-elect and say that they may look good on paper, but generally speaking, yeah, historically, history's against it, and as Mike says, common sense would suggest that I don't think many Americans want to pay 30% more for their iPhones. I think there'll be absolute hell on if that's the one of the logical conclusions that comes out of it.
And the whole idea of the fact that you can take, because you know, China's a currency manipulator again. Clearly, it isn't. If China's a currency manipulator, what's the EU and Japan? You know, UK. You know, there's been far greater moves in those currencies than there ever has in the yuan over the last 5 years. So clearly, that's not the case. So you know, trade embargoes and this kind of stuff. You know, that's going to, as you say, push inflation higher in the US. You know, at a click of a switch. Again, that's not really what we want.
We've got a question right at the back for Andreas, please, then one over here to the left. Thank you.
Yeah, hello, ETF question. If I buy an IT, I know that 100%, or maybe a bit more with a discount, is actually invested in bonds, equities, and they'll have some sort of direct link to that, even if the issuer gets into problems. With an ETF, what sort of percentage is directly in the assets, and what's in sort of, how should I put it, fancy instruments, where the issuer might disappear?
Question on collateral, then the question of physical versus synthetic, I think.
We are, about 90% of what we do are full physical replication. All of those ETFs I mentioned there use full physical replication. Every stock in the index and the weights of those stocks, that's exactly what we do. We have full physical replication. Now, just to clarify, with there are some cases where a swap-based or synthetic ETF is either necessary or it's used as an alternative. Emerging markets is a good example where some customers prefer to have a swap-based or synthetic ETF tracking it because it's easier to get closer, tighter tracking against the index, because emerging markets is quite complicated, a lot more complicated than I understand. But you know, it's more difficult and more costly to replicate that way. Just to clarify, due to UCITS rules, a commodities ETF, an actual ETF, must be synthetic. But just to clarify, to put your mind at rest, hopefully, and that's due to UCITS rules. You cannot take physical delivery. You can't take physical delivery of aluminium. We don't have trucks delivering aluminium behind our offices. Delivers. You have to use futures contracts in the underlying index that you're tracking. And also, UCITS rules state that you must have at least 5 underlying assets which you're tracking. So this will come as a real shock to many of you. Under UCITS rules, there's no such thing as a gold ETF. It does not exist. You'll be like, what? You're kidding me. Under UCITS rules, there's no such thing as a gold ETF. I'm not lying. You go have a look at this. I didn't make up the rules. I think it's a bit silly, but that's the UCITS rules. But getting back to your point, so and in that case, with a swap-based ETF, we have collateral. Those funds are at least over-collateralized by at least 5%. So the assets there'll be assets like government bonds and blue chip equities, which are held to the tune of about 105% of the value of the fund. And again, it's still an ETF structure. So if the issuer went bust, ultimately, those assets, the G10 government bonds, the equities, would be liquidated, and that's what you own, you as the beneficial owner of that ETF. So I don't mean to, we're mainly a physical player. We're not Lixor, which is primarily a swap-based player, but I can tell you, even those funds are, I would argue, very safe, swap-based funds. I know there's been so many scare stories about them. Yeah. Well, we heard you. Yeah.
So when I'm looking at an ETF, how do I find out that sort of relationship to physical ownership? Or what do I look
It should
for
say, the fact sheet would have to say replication methodology, and it would either say physical or cash, which is the same thing, or swap-based or synthetic, which is the other type.
And in the case of the synthetic ones, you can log on to the provider's website and it will tell you what the collateral is. There'll be a huge...
Yeah.
It'll
We
tell
have
you,
full details
there you
of
go.
all of our swap-based ETFs have absolute full, transparent detail about everything that's being held behind that ETF as collateral against the swap. And it was up there on one of the slides. The ETF industry, because there was all these finger pointing going on, dare I say I think a lot of it was coming from some active managers. Again, we're an active manager as well. But there was a lot of finger pointing. Oh, these ETFs, they cause cancer. They have asbestos lining. Watch out. And we're saying, wait a second. The ESMA report came out, 5 or 6 years ago, all sorts of stuff. And what happened to the ETF industry said, right, we're going to give the proverbial, Welsh archers routine to these guys and show them what we're made of. And they went out there, and the amount of transparency from the ETF providers is pretty staggering. You can see all of the holdings, the collateral. If there's securities lending, you can see full details about everything in that respect. So, sorry to get up on my soapbox.
And just for clarification, with gold, so it's a gold ETC that people will be buying, not a gold ETF, just for clarification.
Exactly. Now, in those cases, even if it's physically backed, which is a very safe asset in itself, but just to be aware, under UCITS rules, that does not exist. It must be 5 underlying assets.
To be an ETF.
It's an actual ETF, to be a UCITS fund. Again, I didn't make up the rules. I think it's quite stupid, quite frankly. If there's a UBS, under Swiss rules, sorry to go off on a tangent here, Swiss KAG rules, you can have an ETF. They don't use UCITS, they use KAG. 6 floors underground at Bahnhofstrasse in Zurich, there's gold bars all over the place, locked up very safely, I'm happy to tell you. So, and those are backing our gold ETFs in Switzerland. Those are not UCITS, though. Okay, sort of.
We had a question down at the front here, then we've got one in the red shirt there, please. Just 1 second, please, sir. Thank you.
Once upon a time, when I was young, bonds were considered relatively safe things.
There we go.
Today, we look at the Bank of England owning about 1/3 of the national debt, which fortunately has been compensated by the Bank of England issuing more cash to buy that, so that the institutions are net the same amount of gilts, roughly. Doesn't that suggest that the Bank of England can never sell those?
Shall I take this one for the team?
Yeah, absolutely.
Don't look at me.
All
That's
yours.
fine. Okay, I think what I would say is that although Janet Yellen may have raised interest rates 57 minutes ago, monetary tightening, pardon? There you go, yeah. So monetary tightening, she did. So monetary tightening in the States is happening incredibly slowly, which I think would slightly play to Mike's worries about just how truly strong the underlying US economy is, and would certainly be a reflection of the fact that there is more debt in the system now than there was 7 years ago. I think when Ben S. Bernanke launched QE in 2008-9, he talked an awful lot about how this would be sterilized really pretty quickly and withdrawn. And I don't think we've heard the sterilized word used for 3 or 4 years now by any central banker. So I think in that respect, they're still in a very, very difficult position. And I think that tightening will take place. I know we've heard one concern about rates rocketing away. I personally think that they will rise very, very slowly for a very long time, and then, yes, probably actually absolutely rocket when they realise they may have completely overdone it, but that may take a long time to play out. I know it's not the most fashionable view at the moment. I'm still actually probably more frightened of a deflationary shock than I am an inflationary spike, just because debt, demographics, and the internet are profoundly strong deflationary trends that are no different now than they were on November the 7th.
Can I just throw a supplementary?
Yes.
Because in order to keep interest rates low, central banks will have to keep buying in debt.
Well, they just won't sterilise. Yeah.
Yeah, because, for example, China is not going to continue funding the US deficit if they're using the money for themselves.
Well, you can talk about China quite happily, but perhaps.
Well, I can talk about China. No, I mean, it's pretty obvious. I mean, China's used to have 3 trillion holdings in the US Treasury market. It's now 1.3. And partly that's because they've had foreign exchange reserves have fallen for various reasons, capital flight and repayment of overseas debt. But I think it's fair to say that the Chinese won't be funding the US Treasury market in the way they have, especially now they have fixed the currency against a basket of currencies rather than specifically the US dollar. So to hold US Treasuries against a currency which in theory is trade-weighted and floating makes little or no sense. So I don't think you're going to get the support in the Treasury market that you have done from Asia in the past. Elsewhere, it's more of a difficult call. Actually, I think it's probably pretty supportive for other markets because obviously trade-weighted, you're not investing in US Treasuries. Okay, you still have, excess liquidity. You will be investing in bond markets in other areas, but, maybe not the driver it once was.
Two more questions. People are getting thirsty. It's hot in here. There's a gentleman in the red shirt there. We appreciate you standing between you and a glass of wine.
Hello, Mike. Russ, much as it behaves a Lancastrian to ask a Yorkshireman a question.
No, fire away.
This is a very simple question. We've been we're hillbilly investors, but we've done quite well from Brexit and Trump and all the rest of it, and been tracking a lot of funds. The last few days, I've just noticed that in the American stuff, certainly on the high-quality shares we've got in there, that they've suddenly slipped back despite the index being at a record level. Yeah. And certainly the tracker fund has slipped back and has gone off. And when we looked at our smaller
There's an active manager licking his chops here, I hasten to add. I know he's a different country.
To give you an idea, I woke up at 5 this morning wanting to take the profits, and I was shocked to see that it had slipped back and had made substantial losses.
I know we've got a great advocate of passives here, and I think they're fantastic tools. My suspicion is for 2017 is it will be an active manager's year because of this very trend that you've talked about. Because you've already seen substantial bifurcation in the UK, big splitting performance. The best performing stock in the FTSE 350 this year is up 400%. It's a silver miner in Peru. The worst performer in the FTSE 350 this year, I think, is Capita, which is a FTSE 100 company, down 61%. And that's a big gap, and that's a chance for active managers to really start nudging about. I think Andrew mentioned the US has been such a weird market in the last 3 or 4 years because of Facebook, Alphabet, Netflix, Google, Apple. They've been about 70-odd% of the market cap increase in those 5 stocks. In some ways, it's a healthy sign for the for the US market that other stocks are now taking the lead. If you want to get really into it, you can Google NYSE new highs and lows, and the Wall Street Journal will come up, and it gives you a number every day. Stocks at a new 52-week high, stocks at a new 52-week low. And actually, the gap between the two hasn't been that great this year, which tells you that market leadership's been very limited. It's been quite an unhealthy market because most of the gains have come from very few stocks. Now, oddly enough, post-Donald, breadth has improved. More stocks are going up. So actually, from the point of view of a US market, it's probably got a better foundation now than it did 6 months ago. But you're right, there's been a big move away from the big quality growth names because they've done so well. People are now looking more towards areas that were deemed to be less certain before, cyclicals, recovery plays, as Mike alluded to, where they've just been unloved and there's potentially some value there if the growth comes through.
Well, this is the point. I mean, they've been expensive and very popular because they had growth when there was little or no growth around. So you had a lot of investors piling into growth stocks, quality growth stocks, growth at any price stocks because of that certainty. Now we have a bit of reflation, in theory. So you have a steepening yield curve, expectations of growth. All of a sudden, growth isn't scarce anymore. And a lot of people owned quality growth. So you've seen underperformance in things like Apple. You've seen underperformance in things like, Tencent, Alibaba, these kind of things which were massively popular because everyone owned them. And to be honest, the ETF, people putting money into ETF, into these kind of things, kind of exaggerates these large cap performance, etc. So when you get a bit of outflow, it also compounds it on the downside, which is what we're seeing now. There is an element of growth, there's reflation, people are looking at different areas. In the same way that people stopped looking at yield when the interest rates went up, the next part of that trade was the fact that you don't need to pay a premium for growth.
Now, does
And
it-
that's
yeah.
probably where we are.
I mean, it just means there's been a shift in markets. Does it mean that these are necessarily going to be bad long-term performers? I mean, Terry Smith's not going to be losing any sleep over it. I can assure you, as a prime quality growth buyer, he's just going to sit it out because that's his style, right? And if you can afford to, he will say, no problem. And I think, but equally, value has been so downtrodden and so unloved for such a long period of time. Every once in a while, it has its day in the sun.
I think you're going to get an opportunity as well, because I think we both believe, well, if we're right, that actually this is an illusion of reflation. There is no underlying opinion. My opinion there is that we need to see much more evidence before some of these big moves we've seen in markets are actually.
My slight worry will be there's going to be no counterfactual to 2019.
Well,
so,
maybe,
but
but we
see
could
what
get the
happens.
opportunity
Yeah.
in some of these quality growth companies, which are still quality growth companies, but become out of favour rather than in favour. The comments you made earlier. It's pessimism, greed, and fear. At the moment, everyone's greedy, so you should be fearful. But there may well come a time when everyone's fearful, you should be greedy. We're not there at the moment.
Does that help?
It's just that when the index slipped back.
Yeah, I think you're just seeing a huge churn in market leadership right now, which potentially is an encouraging thing, and that means the breadth of the market is better. But yeah, if you're in those stocks that are doing incredibly well, it could mean that they do have a bit of a pause for breath because they've just been so brilliant for the last 4 or 5 years.
Mm.